So we're going to talk about just credit collections risk. And I suppose to start off, I think the first question was really, I suppose, with the pandemic that's kind of happened, has it changed the approach to credit risk, and what's really had to change? And so, Paul, I don't know if you want to start with that. I mean, particularly for your sector, I know you've had some interesting observations of like how it's changed and how you've had to think about how it might change, particularly with some of the constructions of remote working versus not in the office and not in the store, not on the doorstep.
Yeah, so it changed quite radically, as you might expect. So in home collect credit, this is a market that is defined as a market of about 1.6 million consumers. And what makes them home collect credit customers is they leave a very shallow financial footprint because they don't normally get granted credit from normal sources, mobile phone companies, utilities firms, and so on and so forth. So you can KYC that customer. You can normally 80% of the time see a bank account. You can verify the money that goes into that bank account. You don't know where it goes because the bank account is generally a repository into which money is deposited, and then cash comes out, and then bills get paid by cash. So it's very difficult to ascertain whether that customer is good credit risk, a bad one, or something in the middle. So you need to meet them face to face, and that business model was 80% face to face, well, 100% face to face in granting credit for a first time customer, but then subsequently 80% face to face, 20% digital. These days it's 85% digital and 15% face to face. But immediately with the pandemic struck, it needed to become 100% digital and then gradually fall back to cohorts finding their own comfort level once the economy opened back up again. So we were already in a position where we had enabled all of our 2,000 odd agents and 600 staff with tablet devices. And in those tablet devices there were workflows that were embedded. CRA data was pulled through to the tablet in real time to ascertain whether customers were telling you the truth about their income levels. We developed a bastardised version of the ONS data. We stripped out that all of the Middle England factors, so we ended up with a subprime data set. We correlated that with our own multi-million customer record profiles to ascertain where people were telling us the truth about their subsistence expenditure, their utilities consumption, all of their essential expenditures. So all of that was digitised anyway. So the challenge for us was, how do we do that over the phone via a call centre, engaging with the agent, keeping the agent in the loop, engaging with the customer via the agent or via central operations. And we managed to do that reasonably nimbly. So immediately we had the first phase in place within about 7 days. We were able to start re-lending to existing customers within about 30 days, and then to brand new applicants within about 45 days of total phase 1 lockdown. So that part of the operation was quite challenging, but we got through that reasonably swiftly. Changes that we made to credit policy, well, clearly we tightened credit policy. We increased the scoring levels, we increased the disposable income factor, so obviously their verified income minus their semi-verified outgoings to our own data sources. And we broadened the gap that needed to exist in order for us to grant credit. As a result of that, the book today in home collect credit is actually stronger than the book pre-pandemic. So it is probably 2% stronger in terms of its collection to terms. And so we can look back with some pride and say that we did a good job of that. In the digital business, we introduced CIFAS in the period of the initial lockdown, and we also introduced account score into the mix, and we tightened up on the scoring that we applied in our own scorecards and our decision engine. So we have our own proprietary systems for that, which are API linked into the Equinity loan management platform. And we found that the size of that business during the pandemic period almost quadrupled in terms of its customer size and the size of the loan book, and the quality of the loan book also improved because of those new technology partners that we introduced into the mix. So very quickly, there was a lot more complexity to that, but that's kind of the high level stuff.
So it's sounding like in the short term, you sort of dial down the appetite for risk. Maybe the challenge was there around how do you get access to data that you have to make those risk decisions, and now that's sort of like changing going forward. And so I suppose I'm going to you next, Peter, maybe in terms of like what you see maybe with your clients and some of the portfolios in terms of, we talked there about getting the same data and trouble getting the data to be able to make decisions against the risk appetite. I mean, do you think there are new factors we now need to take into account, or extra data we now need to gather? What do you think now? What have you been hearing from clients, or maybe from what you've seen from some of your books?
I think it's little. We've talked a lot about what happened last year and how things have all changed, but from our point of view, and interestingly, nothing greatly has changed as far as the debt books that are coming through and the mix. I think there's been a bit of a change in, potentially a change, and this is coming from what I see in your personal life and things like that, on coming with kids, but historically people used to maybe take a short-term loan out to fund their lifestyle, and then now probably buying individual things. So you see the rise of buy now pay later, and probably a bit of a drop off in the short-term market to do the social side of it. But we haven't really seen a great change in that. I think one thing that we have to take into consideration, I think, is historically when you look at risk, and I've been through, I know I don't look, but I've been through probably 3 or 4 recessions, that people used to plan for it. Yeah. So going back in the time when we were in around the credit insurance market, we used to plan for it. You could see a recession coming from a mile off, and then start looking at the individual sectors that could get affected. And what happened with the pandemic is no one knew what was going to go on. No one knew what was going to happen. Nobody really planned for it to happen. So you had situations where historically you look at, you may have somebody in a low paid job, maybe in hospital portal, well that's actually a key worker. And then somebody who's in a supposedly recession-proof industry, like I came from the Bailey Club, well my job was officially effectively redundant for 12 months. I did other things, but so you have to start looking maybe at sectors like we did in the B2B world, and saying, well, actually, they've got this amount of disposable income, they've got this amount of cash, or supposedly, but what sector do they work in? Are they in retail? Are they in different areas? So I think that's probably going to, from the lender's point of view, it's going to have to change. But from a collections point of view, it's not really, the key bit really still for us is always data. Make sure we've got the right information for the people, and then just carry on. It hasn't really changed very much.
I suppose part of that is sort of getting new data to make decisions. And I suppose, Paul, I'll go back to you just, I suppose, go to you, I suppose, in terms of like digital collections. Paul, you see that, right? Yeah, so getting more data, new data sources. I mean, there's a lot of talk around sort of creating digital processes, those kind of things. That's some of the stuff you've been looking at. What's your kind of view on it, especially going forward, I suppose?
Yeah, so digital is just table stakes, right? So I find it quite incredible. You look at some of the other industries that are advancing some of the technologies. We've talked about cost and so forth, and being data-driven, back to Peter's point, is incredibly important. And I think collections needs to serve a bigger role. I know they're tight on margins, but there's lots of reasons and things that you can do to resolve those particular issues. But from a data-driven perspective, we were obviously born in the cloud. We were born during the pandemic period. But everything we do is around the data and how we look to resolve the debt for consumers. But arguably as well, what we're trying to do is push that back in through a virtuous loop of data that goes back to the client. And the reason we want to do that is because we want to find more preventative measures, whether it's around the type of job that people do, what we're finding out from the engagement and interactions we're getting with customers. And we run a very open, transparent book, so whatever we do, customers are exactly aware of what we're doing and how we are dealing with their consumers. Whether that's information on regulatory stuff in terms of compensations and whether people are being identified as vulnerable, whether this is around the number of communications we're making. Data is the way that we drive this virtuous loop of data. So this is using advanced AI and machine learning models. Digital is just the table stakes here. And I think I'm kind of leaping one step forward, because I know lots of people talk about digital. it's the next stage. This is all about data. And where I see collections changing is its job and duty to provide more preventative measures back in and take greater responsibility for the areas where customers are vulnerable, do need to be handled in a human way. What we need to do though is automate every other part of the journey, because otherwise we don't get to the stage of actually triaging in the right way in this industry. So I'm looking really getting that virtuous loop in place, making sure we're providing more rehabilitation and preventative measures through the data so we can give those insights back to the clients, but then spending more time and energy with vulnerable customers.
I suppose we're going to go to Frank here, just around regulatory analytics. So I heard a bit about customer duty in the last session here. In the last session, we're now also talking a bit about digital and data, and even maybe sometimes hands-off type of interaction. What, from your perspective, what do you think the regulatory view is going to be around that in terms of, I suppose, either allowing some of that development or how to adapt with some of those developments that are coming through? What's your kind of view on what you think the regulators are going to think or how that's going to play out?
I mean, certainly with a lot of our clients, we're seeing on the frontline lending side, the credit granting side is almost universally open banking driven now. And it's very rare to see somebody come into the market without an open banking solution, but it's certainly not a panacea. It's not a complete problem solver for your credit granting assessments. And the regulator's very alive to this, and we see some quite extensive questioning when we're doing authorisations about what about this scenario, what about joint bank accounts, what about vagueness about the information you're getting from open banking. So firms should not be thinking, I've ticked that box, I've done my underwriting now because I'm using open banking, so still having that sense checking around, I don't understand it, I don't understand what this customer is telling me, therefore I've got to dig deeper into it. So that is certainly important. In terms of the sort of very inherently the remote working we're doing at the moment, still continuing to do mostly. They put out some questions about remote working recently, and there's the operational side of things. What my operators do right, I expect them to be doing it within the business. Can I see that? There's also the cultural side of things as well. How do you push out culture to people's bedrooms, people's front rooms? That is incredibly difficult and something that is definitely a challenge for organisations to think about. How can you take those central messages? And this was difficult before we went remote working. How can you take those central messages of conduct risk, of consumer duty, of vulnerable customers, as we're talking about, and push them down to people and make sure that people at the front line in those remote locations now actually get to them.
I mean, how far do you think we'll be able to get to almost like 100% digital processes rather than involving people? There's almost like will that ever happen? So we can talk about will that ever happen? Peter, you shook your head.
Yeah, I think I just don't see you can never set the people out of it. People deal with people, so when we're going down the blending and recovery route, you've just got to be human interaction. What digital bit does is take away. You try and make things easy for people. If they don't want to talk to a human being, that's absolutely fine. But it'll never go away. AI is great. Some of the simple things and some of the learning, but you have to have a human being. I'm absolutely adamant about it that it's the skills that come through recovering money and talking to people, and also learning about vulnerability. So people, you get your vulnerability flagged through data sometimes, but actually having a conversation with somebody. And one of the guys I know from the IWRB, he said, ultimately, a lot of people who are vulnerable don't know they're vulnerable. So they put as many things in there as they can, but they don't know that. And so someone's actually having a conversation with them and flagging these things up and saying, actually, there's something wrong here, we need to sort it out. Then that'll never ever go away. So, what adamant about that, really.
And I suppose going back to Paul around the digital side of things, how far on that continuum do you think we'll be able to get? See you guys. We'll see how I'm going to come back to that question. Paul, do you want to ask that question?
Yeah, we're fortunate, right? So I don't have technical debt like many companies, many credit lenders. It's incredibly difficult to transform. I've been in companies that have helped massive transformations across banks. It's still difficult. I run the mainframe business for IBM. We're still running with an awful lot of legacy in our organisation. The point I guess I'm trying to make around the use of data and using AI and machine learning, the very best technology, is that we use people for the very most challenging, most emotional, most empathetic problems to solve. We can't continue to triage by just outbound dialing, a terrible form of robotic processing. It's a bad piece of technology. We have to use AI machine learning in a way that allows us as human beings to create those interactions, right? But it can't be for 90% of the journeys. It just can't be. We can't afford to do it. I'm not talking about myself personally because we've got big investment, but I'm talking about the way the industry needs to look at solving the problems. It's the same way, I've looked at it in healthcare. You look at the process that's going on right now in terms of transformation in the industry. It's a good analogy where arguably nurses are going to be more important than doctors because a lot of things that doctors do today, they're not dealing with the human side of the journey with healthcare. It's mostly the nurses. And you can see those jobs being more important rather than doctors, for example, where you've got technology that solves many of those issues. They're not dealing with the empathetic problems that people are solving when you're in health. And the same applies in this space. And so we're using technology so that we can spend more time, more energy doing the last mile, if you like, unbundling that last loop of discussion with individuals. That's what we're trying to achieve. And I don't want to offload it to debt advice companies. I don't want to offload it to other companies. I feel like the creditors and us as companies, as collection companies, need to take more responsibility for that. Now, don't get me wrong, a lot of companies don't give us that right? They like us to look at debt for 42 days, 56 days. So I have to do things, yes, I have to be metric oriented to performance, but we're getting performance by the virtues of doing these digital conversations, allowing people to do it in their own time, in their own space. And then, yeah, sure, if they want to call us, we'll talk to them. But it's always triaging to that end point. And that's how I see it changing.
The triage of the segmentation piece, using the AI to the segments to be able to work out.
Yeah, I'm not a fan of the word segmentation. I'm not a fan of. I mean, I guess you could say it's this concept of personalization all the way down to, I'm not saying we're doing it exactly now, but it's personalizing it down to the very language. There's technology out there that can write the scripts that are written in the letters. If you want to send letters, that's great, or in the conversations with web chats. The technology advancements that are being made right now are there to be taken advantage of. And I just see this sort of concept of digital being a sort of a blocker or a sort of a way for us to, just get to the first level. There's so much more that we can do with data. There's so much more that we can inform and help clients do a better job of actually making the right decisions. This is a virtuous loop of data. Yeah, sure, you've got some CRO information. We work with companies like Data on Demand. We get a lot of that data in. But we're also looking at these customer interactions, as Peter said, and actually handing that data back and going, what kind of information is that telling us about the cohorts, about the personalization? We work with an energy company and they sent out 1 million underpayment letters. Right? We all know the bills are going up, but they sent 1 million. I said to them, what you should be doing is looking at identifying those cohorts of customers that you can actually selectively choose on, because now you're starting to piss your customers off. You're sending 1 million just random notes, right? Yeah, everyone owes us money. And so it's that kind of concept. And they're a relatively young company, right? God only knows whether they'll make it through the next few months or so. But the reality is that's how you can start to inform on the customer journeys. Collections can play a much, much bigger role than it's playing today.
So I think you're talking about the customer journey there as much as the actual technology piece, but it sort of augments it.
Yeah, I don't own the whole customer journey. I don't own that. What I can do, though, is help them do a better job in terms of communicating, interacting, and the journeys that they put in place. And I think that's a lost part of what we do in collections, is taking that data and giving it back to the primary creditors to actually do something with, whether it's from a risk perspective or whether it's just improving those journeys.
Yeah. Okay. So Paul, I'll come back to you from a lender point of view. I mean, so we talked a bit there around digital, particularly the collection side of the journey as well. I mean, what's the balance? I mean, there's been a lot of investment, I suppose, from a risk point of view in the collections piece and understanding what the risk is on the book and the contingent liability. Do you think the pendulum's now going to swing to the front end a little bit more from a credit point of view? I mean, do you think there's an appetite to lend more, and how much appetite is there to lend more? I mean, is that where the investment's going to go? I mean, what's your kind of view from a market point of view at least, and from a consumer point of view, readiness to borrow?
So from the influx of applications and applications approved for credit, they've quite literally gone through the roof in the digital business, and there are two constraints there. One is your risk appetite, and the appetite that you've got for impairment and default within that book. So certainly I think that ours at the moment is probably at the cleaner end of the spectrum of risk appetite that we have, so we could afford to allow more customers to come through that journey, in particular for longer term lending, for 18 months to 5 years for sums of up to about £5,000. There is a huge demand out there and a great shortage on the supply side. The issue that you've got there is that you need an adequate level of funding to be able to furnish those customers. And speaking as a practitioner, then in a subprime market, which is emerging from a global pandemic, you're going to do well to find a long queue of funders who are willing to give you 50, 75 million to go and lend into that market. It is a very select number of funders that would be interested in funding you in that area. Now, we're lucky to have had a few funders in a syndicate that have been with us since pre-float, so pre kind of 2016, and they've been with us ever since. And they've got experience with us, they know us very well, they know the quality of the repayments, and they're very happy to be with us going forwards. But to furnish the demand that is out there in the marketplace and the shortage on the supply side, then we're going to need a whole lot more funding going forwards, and the cost of that funding is quite expensive. So in my market, that generally tends to be up and around about the 10% cost of funding. So firms like mine also need to now start thinking about, okay, well, if it's not debt funding, can it be equity? Can it be some form of boutique bond? And so that is the challenge that we're facing into in my industry. Huge amount of demand. There's probably enough quality out there for us to grow the book several times over. There is a shortage of lenders that have the risk appetite to enter this market. Those that do attract a premium in terms of the cost of that funding. But if you can solve that conundrum, then I would think that over the course of the next 3 to 5 years, there is a massive growth that can be achieved, because a combination of CMCs, the FOS, and perverse attitudes from the FCA have combined to decimate the consumer credit space. And so we've seen many large-scale and small-scale operators exit the market or being forced out of the market, and therefore we're in a situation where there are a handful of last men standing, and we're very happy and proud to be one of them. So those are some of the challenges that you face in accepting more credit and getting more growth.
Yeah, so it sounds like there's huge demand out there, but it's the funding that's acting as the constraint at the moment. I suppose if that does get solved, I mean, will that, the danger is, will that go through into like arrears issues in sort of like 6, 12, 18 months time, I suppose, generally, rather than depending on your risk appetite, I suppose.
You run the risk of that, of course, but then again, the apparatus that I described that we've built out into both sides of the business, we're quite confident that is robust enough to be able to prevent any large-scale increase in impairments. If you look at our home collect credit business, ever since year dot, we've informed the market that our impairment range is between 22 and 26% of book. Currently, it is running at something like 14%. So it is way below our minimum risk threshold. In the digital business, IFRS 9 accounting standards means that book is running in excess of our risk appetite. But that is only because of upfront provisioning. So when you quadruple the size of your book, the amount of upfront provisioning that you have to make for that growth outweighs the value of the contract that you wrote in the first place. And then it's a timing issue of releasing all of those provisions back into the P&L. So it's an artificial kind of picture that is being painted on that business at the moment. But we're comfortable from the collections data that we've got that the underlying bad debt within that part of the business will eventually wash out to be, absolutely fine and completely within our risk appetite. So I don't fear that more growth in either side of the business will create a credit problem that we can't live with.
Yeah. What about from a debt purchase point of view? And Peter, I don't know if you got maybe a view on that. I mean, do you think funding is going to impact the debt purchase sector in terms of purchasing debt, or?
We're not a debt purchaser, but
Yeah.
I'll just give a view on it. From a wider point of view, lending wise, we hope people don't stop lending, because otherwise I'm not going to have any customers in 2 or 3 years. But I think there's an appetite in the market now for what we are seeing with the debt purchasers and also with customers is that there's a lot of old debt about that they're trying to turn into cash just to try and lend so they can start lending out again. Mm-hmm. So in the past where people have just said, look, we've just written this debt off, it's been through a debt recovery company, we can't get anywhere with it, we're just going to write this thing off. There's now an absolute appetite to look at back books, whether they're going to sell it or whether they want to try it again through a debt recovery company, having rested it, added some data to it. And I think what's going to happen in the debt purchase market is that there'll be funding coming through for them because there is all this debt sat there. And I even go back to what Russell was talking about with the local authorities. There's going to come a point, I think, in a period of time where even that market's going to open up, where there's going to be some sort of process set up where that debt could actually be purchased. The public debt, because it has to be collected somehow. And the local authorities need the money, and businesses need the money.
Mm. What about new strategies around collections and those kind of? Are there new ways we need to think about that in terms of strategies around actually collecting on the debt? I mean, is that any thoughts on that?
I know we keep banging about data, but I think that is the key bit. So historically, as CRS and other businesses I work for, if we've got contact information and we've got some background about the customer themselves, then we can build a strategy. If all you've got is the name of the debtor, and we have to say customer these days, sorry, but the name of the customer, the value, and where we think they live, you're fairly limited in what you can do. So the more and more data you can add to it, the more you can come through. And we're looking at things with some of the debt purchasers where we'll do a pre-wash, or some of the creditors where we'll do a bit of a pre-wash. See what we can get out of it. See if there's any quick wins. Then they sell the debt. Some customers of ours have got debt that they basically want to do a fairly quick early arrears strategy and then sell it. Well, is there some sort of mileage in keeping it for a bit longer through a different way of doing it, or actually are they holding on to it too long, and they should just sell it? So it's feeding that information back to them. So it's forever changing. It's never. I always challenge Ben, who I work with. I'll get the deal in, and then I'll tell him what it is, and then he has to come up and find 15 different ways to do it. Yeah. And that's what we call. So it's forever changing.
I think there are also, if you look at the buy now pay later credit providers, we're having to work incredibly hard, I think, to create different options for consumers to get them onboarded. So many of the things that we do from a product, because we're a tech and product company as much as we are a debt collection company, is thinking about the different ways that you can collect. So we almost see, whilst we work with buy now, pay later companies, we also find that we have to be as smart as them at building up the payment options available to them. So whilst that might seem like an extension of what they've already got, that's what we're competing against. We're not necessarily competing against ourselves. We're competing about what's available in the smart ways that people can borrow money today without any form of hurdle or documentation or application to fill in. So we find ourselves, we're always encouraging customers to think, or clients I should say, about making it as flexible as possible to find the different types of payments, allowing them to pause for a month, and allowing for it to continue. So it's that flexibility that is incredibly important, certainly within our customer journeys, to allow customers to make the right choices for themselves in context of everything else that's going on.
And I suppose, Frank, from a regulatory point of view, I mean, how do you think what do you think is going to be new from, I mean, if you're sitting there in credit risk, what do I need to worry about most now? I mean, we talked a bit about consumer duty or those kind of things, but I mean, what would you say would be the big ticket items that people have got to have on their radar screen?
I mean, certainly as people are thinking about turning the taps on to increase lending at the moment, it's incredibly important to have that honest conversation at a senior level within the organisation, so at board and exco level. And there's multiple sides to it, as Paul was mentioning. There's obviously the can we lend? So do we have the capacity? Do we have the credit lines? Equally, do we have the risk capacity around provisioning? Should we lend as well is an incredibly important one. So, should we be lending to these people? Should we be using the same models we were using before the pandemic, or should we be thinking much more about sustainability going forward and whether the person can, keep that loan not just now, but in the future during the life of the loan as well. And in terms of things like consumer duty and vulnerable customers, there's a lot of focus, particularly on vulnerable customers, around the operational side of things. Am I thinking about all the different types of vulnerability, etc.? There's less focus about the other area, which is around strategy. So again, it comes back to the board and am I thinking about vulnerable customers when I'm making this decisioning in my organisation? And same with consumer duties that comes in. It is going to be very much around, should I, as an organisation, be doing this, as opposed to the sort of nuts and bolts operational side of what's happening.
I guess one comment, Kevin. I think we've talked a lot about FCA regulation, and from what I see, and there's no disrespect to anyone, that I see a lot of reaction to what the FCA do. I'm wondering whether boards and investment and shareholders starting to think differently about vulnerability and social good around ESG, and what do you think ESG has on the way that we'll move forward? Because I think this is setting the scene for the next 10, 20 years is, we're a B Corp. If anyone knows what a B Corp is that it's beyond profit, it's also purpose. And you've got to start thinking in those mindsets. How do you embed culture? Now, I don't particularly need to sign up to things except for the fact that it's a signal to people because we have the right culture in our organisation. But I'm just kind of, and also we have the right investors who think long term about where this industry is going. But I'm kind of interested on your perspective from credit and collections. ESG, is that going to define the way that people think about how they change the appropriate nature of credit and collections?
Yeah, absolutely. I mean, when we talk about ESG, when firms think about ESG, there's an awful lot of focus on the E bit of it, and obviously COP26 at the moment, and that's fine, but the social side of things, and particularly the governance side, is less thought of, and that what is our purpose as an organisation, what should we be doing, and how do we govern and control that? And you mentioned investors there. We see a lot of challenges from the sort of mind and management. Can the firm, the SMFs, demonstrate they've got the mind and management in the firm, and are they pushing back against investors, pushing back against private equity in particular? I mean, we're seeing this morning that Metro Bank's a target for private equity, and there's been a lot of others going through that process. And being able to challenge your unregulated parent, your unregulated investors, to say, no, we cannot do this. No, personally, I cannot do this because I'm an SMF. I've got the responsibility. So you have the sort of should do side of things and the want to do side of things, which comes from the culture. So the S side of things, what are we doing as an organisation is incredibly important.
So we talk quite a bit, it's interesting, especially on the back of the stuff that's been going on in Glasgow as well. I suppose it's sort of been top of mind, it's interesting, ESG. But we talk quite a lot about data, and it came up in the last session around collaboration. I mean, how much of the data that, if we're going out to get extra data, and you have internal data, you have potentially new external data as well, how much can we as an industry, should we collaborate in terms of sharing some of that data or getting external data and sharing that rather than, capturing it twice or multiple times across the journeys? I mean, is there a balance? Is the balance there between that? I mean, either of the pools in terms of, do you have a view on that, or is it's my data, I'm going to buy some of the data, versus is there a role to collaborate more?
Firstly, whatever we do, we are completely open, transparent. So we provide the machine learning models will choose how, when, and who to contact, but it's prescribed, it's explainable, but also all the journeys that are taken, all the data, frankly, is not mine. It's the lenders, or it's the energy company, or it's the telcos. It's not it's their customer. I'm just acting as a proxy for what they need to do in terms of going through that recovery process. And we believe we do a better job than they can. So I think the first point is it's their data, right? So that's the first point. So we're completely open and transparent about everything we do. Obviously within secure measures, because that's an incredibly important thing in terms of PII and arguably GDPR as well. But putting that to one side, the more that we can share, I think arguably also, and I would like us to do more of this, which is sort of insights rather than just visuals of data. The more insights we can share, not necessarily the underpinning data itself. I'm very happy. I don't care who has it. I don't care who has that type of information. If I can share more information on the challenges that customers have in terms of priority debt when it relates to energy, I'm very happy to share that kind of information and where the problems exist. But I would also say more so, I'm trying to find not just the connection across the collections, but also for debt advice. I mean, one of the things that's troubled me somewhat is the move that the Money and Pension Service have made to sort of centralize money and put it into phone call handling, which interesting from a triage perspective, but I would not want to see that money being taken away from communities and local areas and cities that need the help the most. So the more that I can start to share, more I can identify where we've got pockets of problems, we're going to start to try and work out how do we help local advice so that it gets out into the very specific areas. So I don't know if it's sort of sharing with collections teams per se, but it's definitely sharing with the primary creditor, and it's definitely working out how do we pass that information back for meaning.
And I suppose, Paul, I mean, from a lender point of view, I mean, do you think there's other information, I mean, in terms of like sharing information out with other businesses, or getting information that's being shared from other businesses into you from a lending decision point of view? Do you think that's, I mean, we're going to see more of that? Is that of value? And does it help shortcut and improve the customer experience?
So first of all, I agree with a degree of altruism in terms of doing the right thing by the customer and developing a good cultural approach to lending, particularly to vulnerable communities. And we do lend to vulnerable communities, and we lend to stretched families. So I'm all for participating, and we do indeed participate with data sharing for the good of customers. But I'll approach this just for a devil's advocacy point of view and talk about reciprocity and the dangers that lie therein. We need to be very careful from 2 points of view as a lender about how much data we share and who we share that data with. Firstly, from a commercial point of view, you can very easily pierce your own bubble by sharing data with somebody that's got an absolute appetite to make very sophisticated technological interventions further up the tree with your customers in order to prevent you from accessing them for repeat credit sales in the future. So they will use all of the data that they have not invested in building, that they have invested in developing a network of contributory partners, so that they can draw in all of this data and then intervene in a customer's journey much faster than you can intervene with a customer's journey, and therefore completely undermine your commercial existence. So that's the first point. The second point is we need to be very careful about the rules of reciprocity in terms of allowing firms to have access to data that they will use to be highly selective about the customers that they're willing to engage with, and therefore create a digital ghetto of customers that can't gain access to credit anymore because they don't fit the digital profile that looks like the exemplary profile for the granting of credit. And those digital ghettos will ultimately translate into real physical ghettos of people that are financially excluded. And you see an element of this in America with data surrounding medical insurance, where some people have become completely uninsurable on the basis that there's been too much data accessed by bad actors in that market that have made those customers uninsurable. Same kind of thing can develop in this country in financial services, where you will find a community of people that are completely unservable because people have pieced together enough of a mosaic of information to completely exclude them, and I think that's very dangerous. So we just need to keep a very close eye on where we draw the boundaries on this reciprocity.
Yeah, I've certainly seen that before. It was in the Canadian market in insurance, where motor insurance, they had limits on how much you could share. Otherwise, some people would just never be able to drive a car. I mean, and they were regulatory limits, and I suppose, Frank, I suppose come back to you in terms of do you think the regulator's going to get involved in that data sharing piece in terms of sharing too much data, and sort of where will the lines be, or where are the lines already in terms of that?
Yeah, I mean, it obviously cuts into GDPR as well,
Yeah.
in terms of access and use of data and what the data is, the purpose of the data. I mean, certainly they see benefits of sharing data without question. So open banking is a clear part of that, and the ability of people to understand that broader credit risk or broader indebtedness across multiple parties. And I know, Paul, in your sector, it's a particular challenge to actually get that insight, get that information. So more availability of that information will be, the view from the regulator generally speaking, is that will be of benefit, certainly. Yeah.
So we haven't quite reached that limit yet, but I suppose calling out that there might be limits in the future as to think about. Yeah. Okay, so we're almost at time. I want to talk a little bit about sort of almost like over the horizon risks from a credit risk point of view. I mean, what are the things that as a group we've got to have on our radar screen today? What's happened, but what are we got to thinking about going forward from a risk point of view? Should we start at this side? Maybe Paul, yourself.
So there are multiple risks. I think the first one is the unholy trinity that exists between CMCs, the FOS and the FCA. The FCA say that there is no rule on re-lending to existing customers. The FOS say that they do not set rules because they are not a rule setter, and yet they pass down judgments which excites the CMC market to create a doom loop, almost a self-fulfilling prophecy of an ever-increasing bow wave of claims that are conjured up from a rule that hasn't been set by FOS, that isn't a rule, but that might be a rule, but they don't want to say it's a rule. So nobody will tell you how many times you can re-lend to a customer. Apparently there are no rules governing this, but today there are a huge number of CMCs, and out of the perimeter, out of the FCA perimeter firms, legal firms, that only operate as CMCs but don't call themselves CMCs. And I think that this is probably the biggest existential threat facing the credit market today, because unless it is checked, unless there is something that is introduced, probably at FOS, I would say, rather than the FCA, that actually puts some onus on the CMC market to do proper due diligence before they weaponise data and submit it to FOS in order to create a bow wave that will drag firms down into not existing anymore, until something is introduced at FOS level. And I'll be quite specific about what it is. If a customer goes to FOS direct, it should always be free of charge. No charges should ever find their way back to an independent, individual person making a complaint. If it comes from a solicitor or a CMC, and the FOS decide you've not done the proper amount of due diligence on this claim, and the claim is unfounded and it's frivolous, you, the CMC, will pay the £900 including VAT fee for that piece of administration that the FOS has had to undertake, and you are not permitted by law to pass any of that charge back onto a consumer. That will stop the influx that is currently drowning the FOS at the moment and causing them to make summary judgments and to breach their statutory obligation to look at each and every individual claim on its own merits. They're not doing that. They've created a mass claims unit, which it's at odds with actually looking at every single claim on its own merits, because it's a mass claims unit. So how can they be looking at all of the merits of an individual claim? And the more that they pump through that mass claims unit, the greater the excitement in CMCs, because they just say, this is great. We're hitting them with so much volume, they can't cope with it, so they make faster and faster and faster judgments just to clear the decks, hoping that they'll come to an end of it, and there will be no end in sight. And it's not just high cost short term, it isn't just consumer credit. In the FCA Small Business Practitioners Panel and in the Practitioners Panel, that behaviour, that conundrum is hitting banks, big insurers, credit unions, brokers, IFAs. It's hitting a broad church of financial services institutions, and it will bring a huge number of them down, which will spell disaster for many of the service industries that feed into the practitioners.
Okay. Right. Paul, great. What keeps you awake? Future risks?
Aftershocks. And I'm actually, the pandemic, and we're obviously with COP26, with the environmental changes, I think we're going to see, I talked about this a decade ago, and these things don't always happen as quick, but when they're here, then we're too late to deal with them. But we're seeing industry changes across the board. Now, that's got an implication for credit, it's got an implication for collections. And so, the rapid changes that I see day to day within the energy industry, just from acting on behalf of providers, I can see how this is going to continue to change. We're seeing how technology is disrupting industries, not our own necessarily, but we're seeing those changes. And I think that's going to have an implication for people's ability to borrow, to take credit. And what that really also says is that things are going to change very quickly. So I think someone mentioned earlier about the idea that someone starts a journey, they borrow some money, they may even be on a 3-month buy now, pay later, and before you know it, they're actually not getting the income in to pay for that. And so the need for data, the need for that insight, and the need to be able to develop new strategies is incredibly important. I'd also say that, that's where people should be investing, whether you're credit or collections. And the social good side of things, I think, will start over the next decade, I believe. I'm hoping, this is my aspirational view, that we're not sort of stuck by getting guidance all the time from the FCA, that actually it's ESG, it's the investors, it's the shareholders that actually realise that that's what consumers want, that's how their businesses are going to thrive, and that's why they will actually look out for what are the best things to do for consumers, what are the best things to do for their customers, and therefore we'll take always the right side of this rather than the wrong side.
It's quite interesting on almost like second order impacts of what's happened. You've got first order, then you've got second order and third order impacts, and it's those things that can be unforeseen in terms of like, how do we now need to react to those, and whether you've got the right things in place for it.
Yeah, 100% agree. And
Yeah.
I think we are only just now starting to see, when we think we're out of the pandemic, we're moving into this industry problem. We're talking about environmental impacts that people will start to decide where they're putting money.
Yeah.
And I see it from our own investors, right? Who are saying to us, these are the things that we're looking for from you. Not just culture, but the way that you think about social good as well.
Yeah. Frank, what do you think is going to keep us awake from your point of view?
We've talked about claims management companies, and that is obviously a challenge. I think the coming out of the pandemic, the regulator going to be focusing on looking at what firms have been doing much more, unfortunately, in terms of things like the credit granting and also the collections. We're already seeing that on the collection side of the collections, the COVID-19 rules. And I think the important thing for organisations, and this is a bit of recommendation, get your collections and your credit granting, your sales team talking to each other. And if you're thinking about turning on the taps, if you're thinking about getting more into lending going forward, make sure the collections has that voice in that decisioning and make sure they're listened to. And equally, obviously, make sure the compliance department are listened to as well. And if you do have a compliance department who are effectively business prevention officers, then get yourself better compliance people, because they should be internal consultants. They should be helping you drive that business forward. They're not there to stop you doing business. They're there to help you do business safely. So all elements of the operational team, all elements of the governance team working together going forward is going to drive the business, definitely.
Yeah, so that's kind of like the linking of collections to the upstream, as well as any collections instance into other common factors, and I suppose that comes back to that customer duty piece to a certain extent.
Yeah, without question. You need that 360 view, and you need to bring in all those elements, both in operations and in the control functions, yeah.
Yeah, yeah. And lastly, Peter, from your point of view, I mean, what do you think of the over-the-horizon risk we've got to have on our radar screens?
Well, I think from a personal point of view, and well, from our business, the government have done a fantastic job paying, pumping all this money into the economy to keep everyone going, but at some point it's going to have to be paid back, and I think we're now starting seeing that now with the interest rate, or the proposed interest rate rises. But I think we've got a duty on all of us for the younger people to do some education about credit and the ramifications of borrowing money. My daughters, I've come through a period where we get cheap credit, they can have what they want pretty much because we can afford to pay it back the next month. They're now going into the adult world and things are changing. It's not the same as it was 5 years ago. Things are completely changed, and and again from a personal point of view, they're clueless when it comes to money. Well, just borrow the money. Well, how are you going to pay it back? And there's got to be. And I sound like an old fuddy-duddy, but when I was younger, if I couldn't afford to go out coming up to payday, I stayed in. These guys don't think like that, and I think we need to do something, whether it's from a government point of view or an industry point of view, just to say, look, this is the ramifications of borrowing money. If you want to borrow it, fine. You know where you're going to be with it. But have you budgeted? And really whether we're going to schools or going to colleges or put something out there to say, look, this is what we need to do. And I think that's what keeps me up at night about what's going to happen. When they've got to start paying this money back.
Yeah, yeah. The S bit in ESG, I suppose.
Yeah.
Yeah. Okay. Well, thank you each of you. Thank you very much for joining again. Some really fantastic insight. Really appreciate everyone joining us today, and fantastic. So thanks for the questions as well. We managed to get a couple of them in, which was great. I think now we're going to break for lunch. So I think it should be waiting outside, right? So it should be waiting outside. So thanks again, and we'll see everyone back here at